Household and corporate balance sheets in Singapore remain resilient, according to the Monetary Authority of Singapore's latest financial stability review. But MAS cautions that ongoing economic uncertainties and softening labour markets could affect those who are highly leveraged. Michelle Tia reports.
Cooling measures in 2018 have helped temper housing loan growth, and overall household balance sheets remain healthy. Liquid assets like cash and deposits have exceeded debt. But the central bank warns that with tightening labour market conditions, along with an increase of built but unsold new private homes, households need to be cautious in taking up new debt. Still, analysts say that it's unlikely that there will be more property curbs.
There are uncertainty factors in the market like large supply and the slowing down the economy. So probably it's a very tight kind of balance to make sure that the market will not be overly stressed by new measures, and at the same time they actually can sustain the demands and also the uncertainty in the market. So I don't see in short term there will be changes or new measures that will be introduced unless the prices actually shot up in the next 1 quarter or 2 quarters significantly.
On the corporate front, the central bank's stress test showed most firms can withstand shocks from changes in interest rates and earnings. But firms in construction and trade-related sectors are still under pressure. Analysts also say that other sectors could see weaknesses.
If you think about what it means for the bigger picture, it's not actually quite so great for things like, the banks, their profits, and for the stock market, because it means that with slower loan growth and a slowing economy, revenue growth is going to come way down in this much more stable environment. So it's healthy from a financial stability perspective, but it does mean that the profit growth of the Singapore banks is really going to slow over the next years.
While Singapore's financial system remains healthy, MAS has urged local lenders to monitor their foreign currency liquidity risks, and that's especially as net interest margin, which is a key gauge of a bank's profitability, has come down amid a low interest rate environment. Rate cuts by various central banks have also led to investors searching for high-yield products, which could mean taking on greater risks to achieve targeted returns. It's also driving capital outflows from advanced economies to emerging markets. And while that means more liquidity for emerging economies, it could also magnify a market sell-off if there's a downturn in the external environment.